Introduction. A fixed deposit FD is a one-time lump sum investment placed with a bank or a financial institution for a predetermined tenure at a predetermined interest rate. FDs rank among the most popular retail investments in India, prized for their capital safety and guaranteed returns. They cater to risk-averse investors, retirees, and those seeking predictable income. How fixed deposits work. Deposit. You place a lump sum amount, starting from as low as 1,000 Indian rupees in many banks, for a chosen tenure. Interest rate. The bank credits a fixed rate of interest, usually higher than savings accounts. Tenure. Options range from 7 days up to 10 years, with longer tenures often carrying higher rates. Interest payout. Choose cumulative, compounded and paid at maturity, or non-cumulative, monthly/quarterly/annual payouts options. Maturity. At the end of the term, you receive the principal plus accumulated interest. Key features. Assured returns, no market linkages. You earn exactly the agreed interest. Capital safety. Deposit Insurance and Credit Guarantee Corporation, DICGC, insures up to 5 Indian rupees lakh per depositor per bank. Flexible tenure. Tenures from 7 days to 10 years suit short-term and long-term goals. Loan against FD. Borrow up to 75 to 90% of your FD value at competitive rates. Partial withdrawal. Some banks allow breakage with a small penalty. Nomination facility. Assign a nominee to receive maturity proceeds. Senior citizen premium. Typically 0.25 to 0.50% higher rates for those aged 60 plus. Types of fixed deposits. Regular FDs. Standard term deposits with tenures from days to years. Senior citizen FDs. Extra interest 0.25 to 0.50% for depositors above 60 years of age. Tax-saving FDs. 5-year lock-in. Principal amount eligible for deduction up to 1.5 Indian rupees lakh under Section 80C. Cumulative FDs. Interest compounds and is paid with the principal at maturity. Non-cumulative FDs. Regular interest payouts, monthly/quarterly/annual. Suited for retirees needing periodic income. Flexi FDs, sweep in/sweep out. Linked to savings account. Excess balances sweep into an FD and back on demand, blending liquidity with higher returns. NRI FDs, NRE/NRO/FCNR. Designed for non-resident Indians. NRE FD. Interest and principal fully repatriable and tax-free. NRO FD. Repatriable within limits. Taxable at 30%. FCNR FD. Held in foreign currency. Immune to rupee depreciation. Tax-free in India. Corporate FDs. Issued by NBFCs/companies. Higher rates but carry credit risk and no DICGC protection. Interest rate landscape. Range 2.8% PA to over 7.5% PA in scheduled banks. Small finance banks offer up to 8.5% for select tenures. Senior citizens enjoy a 0.25 to 0.50% premium. Some special tenures may add up to 0.75% extra. Market trends. Rates mirror RBI's repo rate moves, liquidity conditions, and competitive pressures. Tax implications. Taxability. FD interest is taxed as income from other sources at your slab rate. TDS. 10% if interest exceeds Indian rupee 40,000/Indian rupee 50,000 PA. Regular/senior citizens and PAN furnished. 20% without PAN. Form 15G/15H. Submit to avoid TDS if total taxable income is below the threshold. Section 80C. Tax-saving FDs, 5-year lock-in. Allow principal deduction up to 1.5 Indian rupees lakh. Risks and limitations. Liquidity risk. Premature withdrawals invite penalties and reduced interest. Interest rate risk. Locked-in rates miss out when market rates rise. Reinvestment likely at lower rates. Inflation risk. Real returns can be negative if FD rate, inflation rate. Default risk. Rare in banks, but exists in corporate FDs. DICGC cover only 5 Indian rupees lakh. Tax drag. High taxability reduces post-tax returns, especially in top slabs. Opportunity cost. Funds and FDs cannot capture upside in equity or other high-growth assets. Advantages versus disadvantages. Advantages: capital preservation and guaranteed interest. Predictable cash flow for short-term goals. Simple to open, manage, and understand. Disadvantages: lower real returns in high inflation environments. Locked-in tenure reduces flexibility. Less tax efficient than certain debt funds or bonds. Choosing FDs in your portfolio. Short-term goals emergency fund. FDs offer secure parking. Retirees fixed income seekers. Non-cumulative FDs provide steady payouts. Balanced portfolio. Mix FDs with equities, debt funds, and bonds to optimize risk return. Tax planning. Use 5-year tax saver FDs for Section 80C benefits.